Hello, good evening.
Good
First, we
evening.
have
Good evening, sir.
this federal government. Yeah, good evening. Akoli, I hope you are doing well.
Yes, I'm doing well, sir. You're
All
welcome,
right,
sir.
I can see a message. Somebody says 7 minutes. My time is just 8:34. All right, upbeat. Akoli, please, can you mute? Let's go to the business tonight. Tonight, please, can you mute your speaker? Tonight, we are looking at pricing decision. Please, as you get into the class, check your speaker. I can see Shei's speaker being on. All right, we are looking at pricing decision. Let me do an introduction to this topic to appreciate the topic we are looking at tonight. How do companies determine selling price? The topic we are looking at tonight is a topic that every company, regardless of your nature of your business, the size of your company, the complexity of your processes. Please mute your speaker when you get in. Irrespective of the nature of your business, the size of your company, the complexity of your processes, you must determine the price for your product or service. You may ask yourself, how does equity professionals determine the price you are going to pay per lecture? Equity professional must have considered this price is not static. If you go to the market today, the price of a product today may not be the price of the product tomorrow. Why do prices fluctuate? The topic we are looking at tonight is pricing decision. And I believe one way or the other, it's going to affect everybody. If you are going for an interview, if you claim that you are in a paid job, if you are going for an interview, you must determine your price. You must be able to value your worth. In current times, the employer will ask you, how much should we pay you? What the employer is asking you technically is to name your price. In most cases, we find it difficult to determine our worth. Now let's go to the business. Like I said, regardless of the nature, size, or complexity of a business organization, the most important strategic decision senior management face is setting appropriate selling price. For many products and services, the selling price, Techno, please can you mute? The selling price is the primary determinant of quantity demanded. Look at it. For many products, the selling price will determine volume of demand. Pricing decision will affect contribution per unit, volume of demand, and the profit of the company. Pricing is a decision made and reviewed regularly, meaning that prices are not static. This decision must be made by top management, and management must review the price regularly to accommodate changes in circumstances. Pricing can be used as a weapon to achieve or eliminate competition. Let's explain that. Look at that point. Company can use pricing as an instrument to eliminate competition or encourage competition. A good example, there was a business war between Dangote and Otedola. Dangote ventured into petrochemical business. Petrochemical business is the primary line of business of Otedola. In retaliation, Otedola enters cement business with an intent to import cement into Nigerian markets. It becomes a war between two business friends. To counter Otedola's intention, Dangote slashed the price of cement below the cost price. Look at it. Dangote slashed cement price below the cost price. What is the implication of this? If Otedola attempts to bring in cement into Nigeria, Dangote has slashed that selling price. Dangote has slashed price below cost of production. Implication is that, oh, who is this? Adewumi, please, you are conflicting the class. Please, can you mute? Implication is, if Dangote attempts to bring cement into Nigeria, Dangote will run at a loss. Sorry, if Otedola attempts to bring cement into Nigeria, Otedola will run at a loss. You can use pricing to eliminate competition. Several factors determine pricing. Kehinde Stephen, please, can you mute? Might not be listening, sir. Several factors will determine selling price or the appropriate selling price. Some of these factors include the corporate objective of the company. If your company is established to make profit, you are likely to charge higher price. Alternatively, if your company is established to render services, public service, then you may be charging a subsidized price. So the corporate objective of an organization will impact on the price. Number two, nature of the company's products. If you are dealing with necessity products, fuel, directly or indirectly, everybody is involved in fuel purchase. If you are not taking your car, you are going to ride on transport where we apply. Food items, regardless of the price, we are still going to buy food items. Necessity. Adewumi Kende Stevie, I'll be trying to mute. Your speaker conflicts this class continuously. Thank you. So the nature of the company's products, actual cost of production, the degree of competition, the elasticity of demand for the products. All these factors will affect the selling price. I've mentioned like 5. The corporate objective of the company, the nature of the company's products, actual cost of production, the degree of competition, elasticity of demand. This will have impact on company's selling price. Now let's go to it. Theoretical approach to pricing. Let us look at the theoretical approach to pricing. When we say theoretical approach, we are looking at pricing from economic viewpoints. From the economist viewpoint, that is what we refer to as theoretical approach to pricing. From microeconomic viewpoints, a firm should set a selling price that maximizes profits. Let me repeat that point, please. From microeconomic viewpoints, a firm sets a selling price that maximizes its profits. You recall, the primary objective of a business entity is to maximize profits. Hence, from the economic viewpoint, companies should set a selling price that maximizes its profits. This price, this selling price is at the level of sales where marginal revenue equal to marginal cost. Deliberately, I'm trying to bring down the pace of the lecture because these aspects, calculation we apply. Shoyinka Prof, Please, can you mute? From economics viewpoints, companies should set a selling price that will maximize its profit. Now, to maximize your profit, your selling price should be at a level of sales where your marginal revenue is equal to marginal cost. The selling price at the level of sales, where your marginal revenue equal to your marginal cost, will maximize the company's profit. Now the question is, what is marginal cost? Again, like I explained in our previous classes, marginal cost can be defined from two perspectives. I'm sure I explained this in my two previous classes. Marginal cost can be defined from two perspectives. Now, from the perspectives of the economy, of the economist, marginal cost is the additional cost incurred by the production of one extra unit of the products. It can also be described as the slope of the cost function or the cost curve. The marginal cost is the slope of the cost function. We have defined marginal cost from the viewpoint of the economist. Alternatively, you can define your marginal cost from the viewpoint of the accountant.
Is it just me or this network, please?
It's everyone. He has left the group.
It should be from the same side.
It's not just him.
I have a temporary network glitch. I'm sure and is not aware that speaker is always on. Please, can you put your speaker off? Let's continue. I was trying to explain marginal cost from the viewpoint of the accountant now. Marginal cost from accountant viewpoints is the addition of all the variable costs, the summation of all your variable costs is your marginal cost. Please, can you mute? Now we have explained marginal cost. Marginal revenue. Marginal revenue is the additional revenue achieved or earned by selling one extra unit of the products. Marginal revenue, the additional revenue achieved by a company as a result of selling one extra unit of the company's products. This could be described as the slope of the revenue curve or the revenue function. Please note this explanation, because calculation will apply with this. Demand function or the demand curve. All right, Amarachi says we cannot hear you at all. Please confirm.
I can hear you, sir, clearly.
Amarachi, please check your device. Don't say we cannot, say I cannot.
Okay, I don't know if others experienced it. You were off for some time.
I can hear you clearly, Amarachi. So let me ask again. So the whole class, please confirm you can hear me. Yes, Mr.
Yes, sir, please. Can you come again with that definition of marginal cost?
Okay, but you can hear
So,
me.
yes, we can hear.
Yes,
I can
yes,
hear
I
you
can.
now.
So I will
can hear
define
you.
again. Let us resolve the issue of we cannot hear you. And please do not generalize. So, Amarachi, look at your device. When you speak, I can hear you clearly.
So we are getting a lot of feedback. Maybe those that are not mute should please mute.
I'm not sure when this TV is actually, it's not even aware that this speaker is on. All right, let's go to it. Now, there's a question that we should explain marginal cost and marginal revenue again. Marginal cost. I define from two perspectives. From the viewpoint of the economist, marginal cost is the additional cost incurred as a result of producing additional units of the company's products. I hope that is settled. From the viewpoint of the accountant, marginal cost is the addition of all variable costs incurred by the business. How that point is also taken.
Yes, please.
All right. The marginal revenue. This is the additional revenue achieved by a company by selling one extra unit of the company's products. Marginal revenue. It is the additional revenue achieved by selling one extra unit of the company's products. Demand function.
Please, this
It's
marginal
also known
revenue.
as the demand curve. Demand function explains the relationship between selling price and the quantity demanded. It is called demand function, demand curve. You also call it price function. It is called demand function, demand curve, or price function. Demand function explains the relationship between selling price and quantity demanded. For many products, the higher the selling price, the lower the demand. Please note, all things being equal, the higher the selling price, the lower the quantity demanded. We should record this now in our elementary economics. For example, as fuel price increases, look at most cars. People hardly fill their tank. If you approach a filling station, they will tell you that sales is low. The higher the price, the lower the quantity demanded. Hence, there's inverse relationship between quantity demanded and selling price. This point is very important to us. I will highlight it again. There is inverse relationship between quantity demanded and selling price. When we say inverse, negative relationship. As price is, quantity demanded will fall. They move in opposite direction. That's a negative relationship. Please note that. An understanding of the elasticity of demand for a product also influences the product price. meaning that elasticity of demand can affect selling price. Let me ask the class, what is elasticity of demand? Let me ask the class, what is elasticity of demand?
Percentage.
Yes, anybody? Yes, the Technoman.
Percentage change in quantity
Who
demanded.
is speaking?
Latif.
Okay, percentage change in quantity demanded
as a result of price or income or other factors.
Okay, yeah, that's good. Elasticity of demand measures the extent to which quantity demanded change as a result of changes in those variables that affect demand. I'll take that again. Elasticity of demand measures the extent to which quantity demanded is influenced by changes in those variables that affect demand. What are the variables that affect demand? Price. So if I say price elasticity of demand, that becomes the extent to which quantity demanded is influenced by change in price. If I say income elasticity of demand, that becomes the extent to which quantity demanded is influenced by change in income. Please note that. Let's go on. Marginal cost, like we explained, you can determine your marginal cost as the addition of all variable costs. That is the accountant viewpoint. You can also determine your marginal cost by differentiating the expression of the total cost. I will take that point again. You can calculate your marginal cost as the addition of all your variable costs. Alternatively, you can calculate your marginal cost by differentiating the expression for total cost with respect to quantity. Let us recall our calculus, dy ds, differentiating total cost with respect to quantity will give you the marginal cost. Also, you can derive your marginal revenue by differentiating the expression of total revenue with respect to quantity demanded. Please do not exercise fear. We are going to deal with a bit of calculus here. DYDS. If I want to derive my marginal revenue, first, I will get my total revenue. Then I will now proceed. Differentiating of total revenue with respect to quantity, so as to derive my marginal revenue. Let us do a bit of equation to what we have explained. A bit of equation. Your price function is represented by the equation highlighted. Let me expand this more. Your price function is equal to P is equal to A plus BQ, where your P is the price per unit. Prof. Shoiga, this mute. Your small letter A.
Okay.
Is the selling price at which no quantity is demanded. It is believed that there's a price the company will charge. Nobody will buy the product. Please, just 1 minute. 1 minute, please. Let's continue. All right, let's continue. Now, the small letter A is the selling price at which no quantity is demanded. Theoretically, it is believed that there's a price a company will charge for its products, and nobody will buy that product. That is represented by letter A. Your small letter B is equal to change in price over change in quantity. Please note, there's a negative sign here. In that formula, the negative sign implies negative relationship between price and quantity. Please note, change in price over change in quantity. Recall, the higher the price, the lower the quantity. Hence, you are going to get a negative result. Then your capital letter Q represents quantity. So that is your price equation. The price of a product is equal to 1, selling price at which no quantity is demanded, plus the slope of the price function. That slope is what we call change in price over change in quantity, B, then multiply by quantity. That will give you your price function. Next, your revenue function. Total revenue. Total revenue is price multiplied by quantity sold. Is that not, please? Total revenue is price multiplied by the quantity sold. Look at it here, please. Price, P. Look at the P. Price multiplied by quantity will give us total revenue. We can expand this. Please look at this, please. Our price is equal to A plus BQ. I can rewrite total revenue as A plus BQ into bracket multiplied by Q. Is that not, please? Is that not, please? I can rewrite my revenue function as A plus BQ in brackets by Q. That is your total revenue function. Now, if I want to derive my marginal revenue, remember, marginal revenue is the differentiation of total revenue with respect to quantity. The Y, the X. I'll now come here, look at it. My marginal revenue is equal to the total revenue, the quantity. Tonight, we have to cross it. Do not worry. There is a way to master how to derive total revenue from, how to derive marginal revenue from total revenue. There is a consistent way. Please do not exercise unnecessary fear. By the time we apply question to this, be clearer. So we have explained how to derive price, how to derive total revenue function, and how to derive marginal revenue. Please remember our previous explanation. From the economist's viewpoint, a company should set a selling price that maximizes profits. To maximize your profits, then your marginal revenue must equal to your marginal cost. That means if I'm looking for selling price that maximizes company's profits, I'm going to determine the total revenue. From there, from my total revenue, I will derive marginal revenue. I'll put that aside. Then I will now go to my marginal cost. I will derive my marginal cost. My marginal cost is the summation of all variable costs. Once I get the marginal revenue and I derive the marginal cost, I will now equate the two. Look at it. According to the theoretical pricing method, the optimum selling price is achieved where marginal revenue equal to marginal cost. So if the examiner says, determine selling price based on economic theory, this is what the examiner is asking you to do. If examiner says determine selling price based from the viewpoint of economists, then what the examiner is asking you to do is determine selling price using the theoretical approach. Examiner can also say determine the optimum selling price. If you are asked to determine the optimum selling price, note that the optimum selling price is that selling price where the company makes the highest profits, maximum profits. You may be given like 3 or 4 selling prices. Then I will now ask you, from this price you are giving, which one is the optimum selling price? All right. Any question, please? We can review the advantages of theoretical approach to pricing. One point is that it enables management to focus on that price and demand that will maximize profits. All right. We are trying to look at the advantages of theoretical approach to pricing. Glo Network, don't demarket the company. Oh. I'm always using MTN. It just, and it's very sharp in my area. So please, Techno man, do not demarket any company. When you say Glo Network, you always disappoint. I don't use Glo anyway. I think it's just a bit of punctuation. Let's go on quickly. Theoretical approach to pricing considers only incremental cost. Limitation of this method. The model assumes that firms can estimate demand curve for their products. Look at it. Can you estimate demand curve for your product? If you set a selling price, yes, you can set a selling price, but can you determine the number of people that will buy? At Equity Professional, we have set a selling price per subject. But can we determine the number of students that we enroll? It is practically impossible. We can predict number, but we cannot determine how many students we enroll for the class at the price charge. So when you are talking of theoretical approach to pricing, in reality, it might not be possible. It is difficult to determine the price at which demand will be zero. Look at point number 2. Meaning that what selling price will a company charge? And no customer will patronize the product. It is difficult to know. Point number 3. Majority of organizations tend to pursue target profits rather than the theoretical maximum profits. The majority of organizations tend to pursue a target profit rather than the theoretical maximum profit. If you look at companies generally, company will set a target profit. In most cases, company will not work towards maximizing profits. So what we are saying is, this approach is largely theoretical. In practice, it is difficult to use. All right. Let's move on. Let's go on. We have explained the theoretical approach to pricing. Please note, it's also called economic approach to pricing. You may have this in your exam. Do not be taken by surprise. Examiner has given a question and you are asked to calculate selling price from the economic viewpoint. Please remember, from the economic viewpoint, the selling price must be at that level of 6, where the company will maximize profit. Revenue of the company was equal to the marginal cost. We now move and God, we are back. Other pricing method, we have cost plus pricing model. I will repeat that. Cost plus pricing models. Empirical studies conducted show that the most widely used method of pricing a product is to estimate the unit cost, then a certain percentage markup is added to the unit cost to determine the selling price. Let me recap that. In most cases, companies determine selling price by estimating the unit cost. You are going to estimate the unit cost, then a percentage markup is added to the estimated cost so as to derive the selling price. This approach is called cost plus pricing model. This approach is called cost plus pricing model. If I want to determine selling price of my products, what I will do is, under cost plus, I will estimate the likely cost of producing a product. Then I'm going to add a percentage markup to the cost. The percentage markup will represent my profits. This approach is what we call cost plus pricing method. Now, under the cost plus pricing model, we have like two variants. Under the cost plus pricing model, we have two variants. We have full cost plus pricing model. Full cost plus pricing model. This is also referred to as absorption cost plus pricing model. This method is also referred to as absorption cost plus pricing model. Let me pause a bit and ask a question. What is absorption costing principle? I'm aware, I can see the chart. You want to start something on this. What is absorption cost principle? The line is open.
It is the principle that considered fixed cost as unit.
Yes,
as
anybody?
Hello, sir.
Yes, we are listening.
Absorption costing techniques is the principle that considers fixed cost as part of the unit cost of production of any product.
Okay. He's trying to okay, I'm sure. I don't know, but I know the line is breaking. All right, thank you. I can hear, I can pick from your explanation. Absorption costing principle is a costing technique that considers both the fixed cost and the variable cost. That is very correct. The same applies here. Under the full cost pricing model, approach uses the conventional costing principles to establish total cost for a product. Under this method, you consider the fixed cost and the variable cost of the product to derive the total cost of the product. You are going to consider the fixed cost as well as the variable cost to derive the total cost of your product. In addition, you are going to add a percentage markup to the total cost so as to arrive at the selling price. This is what we refer to as full cost plus pricing model. This is what we refer to as full cost plus pricing model. Under this model, you consider the total cost, both the variable and the fixed cost. Then you now add certain percentage mark up to the cost so as to derive your selling price. That is the concept of full cost pricing model. Next, we have the marginal cost pricing model. Under the marginal cost pricing model, only the relevant cost will be taken into consideration in order to determine the price of a product. I will take that again. Under the marginal cost plus pricing model, under the marginal cost plus pricing model, only the relevant cost of the product will be taken into consideration Please, Ted, what is GG? I can't make anything out of this.
Not for you, sir.
No, whatever is put on this is for me. If it's meaningless, please do not, because once you put something there, I will be forced to check what is there. Marginal cost plus pricing model. Under this model, only the relevant cost is considered. The relevant cost will include all the variable costs. The relevant cost will include all the variable costs and relevant fees. I can see that relevant costing has been shared on the platform. This cost becomes relevant if it is incremental in nature. The incremental fees cost, that incremental portion is relevant. So please notice, if you are required to determine selling price using marginal cost plus method, you are going to look at the question, identify all the variable costs and relevant fees costs. Sum all the costs together. Then add a percentage mark up to your cost to arrive at the selling price. In most cases, the examiner will provide the percentage to be added. Then we have target return pricing model.
What is it? That thing can be from my side.
It's also called return on investment pricing model. This is an approach to estimating selling price. Whereby target return on investment is added to the total cost of the product. target recalculated, added to the total cost of the product, so as to determine the appropriate selling price.
Sorry, sir, please can you come again?
Even without you asking. Return on investment pricing method is a method of estimating selling price. It's a method of estimating selling price, whereby a target return on investment is calculated and added to the total cost of a product. So as to derive the selling price. That target return on investment represents the profits to the company. Is that point taking place? Okay. When we get to question, I should be able to solve at least one question tonight. I've explained full cost plus pricing model, marginal cost plus pricing model, target return on investment pricing model. Okay. The next explanation, to round up tonight's explanation. Pricing strategies. Pricing strategies. Let's do a background to this subtopic. Let's do a background to this subtopic. If a company is launching a new product, if you are bringing a new product to the market, or you are coming to the market for the first time, you have registered your company and you plan to start a bakery business. That means this is your first time you are entering that market. You need to introduce your product with a selling price. Because you are new, you must determine a pricing strategy for you to be able to enter that market. You are going to ask yourself a lot of questions. Is he new to the customer, or we have existing products? Definitely, if you are bringing bread to the market, bakery has been existing before your own bakery. Several bakeries exist in that market. Different bread exist in that market. You are not the first person that will bring in that product. So what price do you want to bring? Your product is new in the market. Your brand is not even known. And you have decided to enter that market. You must determine the pricing strategy you are going to use to enter the market. We have different pricing strategies that companies can use when introducing a new product. There are different pricing strategies company can use when introducing a new product. But two methods are mostly used. What are these two methods? One is market skimming pricing strategy. Market skimming pricing. Market skimming involves charging high prices when a product is first introduced. Market skimming pricing is a strategy of charging higher price when a product is first introduced and launched to the market. And company will spend heavily on advertisements and sales promotion to obtain sales. Market skimming. You are charging higher price for a new product that is newly introduced into the market. The objective of market skimming is to gain higher profits at the early stage of the product life cycle. The objective of market skimming is to achieve higher profits at the early stage of the product life cycle. Now the question will be, when it is more appropriate for a company to use market skimming? You can use market skimming if that product is entirely new in the market. There is no, before now, similar products does not exist. Then you can skim the market easily. A good example was when GSM was first introduced into Nigerian markets. At that time, we don't have telecommunication GSM running. Then we had MTN and Econet. the federal government licenses two companies to operate GSM in Nigeria, MTN and Equinix. People were eager to buy the products. So it is very easy for this company to skim Nigerian markets and charge higher price for their products. At that point, having or owning a telephone is considered a prestige. For those that were able to buy phone then, they are regarded as the privileged class. Even a line, then you are going to buy a phone, you also buy a line. Ordinarily, that line should have been given for free. They were selling line. They were able to skim the market because the product was really new. You can also skim the market if you are bringing in a product that have unique feature, a differentiating feature. If you look at the telephone market, before you know it, you have Samsung S1, Samsung S2. The market wanted to differentiate it from BlackBerry. Then, before you know it, iPhone will come on board. It become a class. Certain things iPhone can do, BlackBerry cannot do, Android cannot do. Then you can skim that market. Ask yourself, some are particular about the phone you carry. Samsung products, it defines a class of its own. iPhone products define a class of its own. You can easily skim the market. Number two, we have market penetration prices. Market penetration price. Let's go on. MTN, everywhere you have MTN. Market penetration is an alternative strategy to market skimming. Under market penetration, when a company introduced a new product to the market for the first time, the company charges a low selling price for the product. The company will charge a low selling price for the new product so as to capture larger size or a larger percentage of the market share. With market penetration, a company introduced new products of this technical glitch will just allow me to run. Now, with market penetration, you can achieve higher volume as quickly as possible. And you can capture the market before competitors can introduce rival products. Yeah. Everywhere I go, I think just today, it's always very, I hardly have problem with my network. It's always very, just today. Like I said, I usually tell students, please won't focus on limitation. We are going to drive the business and focus on our goals. Now, a good example is when we have Techno entering Nigerian markets. Techno is aware that several phones or many phones exist. Well, maybe it's weather, thank you. Techno is aware that many phones exist in Nigerian markets. And Techno want to penetrate that market. The first thing Techno did was to find a way to achieve production of phone at a reduced cost. We call it cost leadership market strategy. The first thing Techno worked on is to achieve production of phone at a reduced cost.
Hello. Can you tell me?
Please, sir, can you mute? It's not even aware it's not in the class. All right, it's understandable. But please don't sleep. Oh. Don't sleep in class. Now, the first thing Tecno did was to try to work towards achieving production of phone at a reduced cost. We call it cost leadership, market strategy. Trying to become the lowest cost producer of a product in the market. Market penetration strategy, market penetration pricing is consistent with cost leadership strategy. To penetrate that market, Tecno was able to achieve a reduced cost of production, hence they can charge low selling price. At a low selling price, Tecno entered that market comfortably. And you know, buyers will compare prices. If you are giving Samsung 120, 150. Oh. Shoyinka, please mute. You don't want to hear, so just mute.
No. Now it's in National Bank of Nigeria.
Shoyinka, please mute.
No.
I'm trying to implement the person. So with a low price, Tecno can penetrate that market. Buyers will now compare prices. Oh, iPhone, Samsung, what have you? Tecno was the cheapest then. And the question was like, okay, is there anything this other phone can do Tecno cannot do? Before you know it, gradually, Tecno was capturing the market. That is the concept of market penetration. So like I said, the first two are mostly used. Okay, Mr. Tecno is responding. Yeah, they are living together today. We also have another method, passive value pricing. In summary, passive value. At times, you are prepared to pay higher price for a particular product because of the passive value you believe you are going to get. The passive value. If you look at, okay, we have to also be careful because this video will also go online, YouTube. But we always take a caveat. This is for knowledge purposes. We are not demarketing any company. If you look at other bottled water, in those days, before now, bottled water sells for 100 naira. But if you look at Nestle bottled water, Nestle bottled water sells for 150. Funny enough, the other bottled water that sells for 100 naira is bigger than Nestle. But that Nestle water sells for 150 then. Some people will still prefer to buy Nestle bottled water. Why? There's what we call passive value. Nestle Food as a brand is reputed and known for high quality products. So some will prefer to buy Nestle because they believe that any products coming from Nestle Food is of high quality. And with that, Nestle can charge higher price. That is passive value. Then we have price discrimination method. Company can adopt price discrimination. A firm selling a single identical product in different segments of the market at different prices. You can segment your market and sell the same products at different prices. You can introduce a new product and say, okay, this product in this market segment, let's assume Lekki market segment, that product may sell for higher price at Lekki. The same products may sell for a lower price at mainland market segmentation. We have complementary product pricing. Complementary product pricing strategy. When we say complementary products that go together. Once you buy one of the products, then you are going to buy the other products. You cannot buy one without buying the other. They are complementary in nature. Company can use pricing with respect to complementary products. Company can charge lower price for the first product. Company can charge a lower price for the first product. By charging a lower price, demand for that product will increase. By charging a lower price, the demand for that product will increase. That first product. Once the demand for the first product increases, then the demand for the second product will also increase because both products are complementary in nature.
I can't hear him again. No. Is this same to everybody?
I took a pause, Nee.
Okay,
I
sir,
took
sorry.
a pause to allow the explanation to sink. All right, any question? We have settled to the explanation. Any question, please?
Well, please, can you give like a practical example of that complementary product? Let's just have a clear. Let's
Okay,
me have a clear.
I'm even trying to
idea.
look at it. Okay, let's look at it. Look at it the way it moves now. Look at along the line. Once you buy a phone, have you observed? Once you buy a phone, near that phone shop, you have somebody trying to give you, what's it called? Protective guard. Screen guard. Have you observed that? Once you are getting a phone, in that phone shop, they will advise you to get a protective screen guard. You hardly see somebody carrying a phone without having on his or her phone a protective screen guard. I'm trying to look for closer example.
Hello, sir.
Yes, please.
Okay, can I give an example?
And why not?
Okay, so you know that these days iPhone they don't come with chargers anymore. So if
Okay,
you are buying
I don't have
an
iPhone.
okay. So if you are buying an iPhone, you definitely have to buy the charger. But the charger doesn't come with the phone. So I think that's an example of complementary
Okay,
products.
because it could also fit in. But it could also fit in that, look, for iPhone, it does not come with a charger. They cannot say, okay, definitely once you buy a phone, you must buy a charger for that particular product. But the logic is, if we reduce more people will buy iPhone, then definitely more people will buy charger. The intent of complementary product is that if you reduce the price of one complementary product, the demand for that product will go up. Because the demand for that product will go up, then the demand for the complementary product will equally go up. Company can now make more profits. I hope it's better. Hello?
Yes, sir.
Yeah, there's somebody that even has, a lady has that question. That's why
Yes, sir.
I'm even trying to see which one we first want to buy. That once you buy this,
What about gas
try to
cylinder and gas?
gas and what?
The gas cylinder.
Please, can you explain?
Okay, if you buy a gas cylinder, you definitely have to fill gas into it.
So if I reduce the price of gas cylinder,
More people will be using gas.
anyway, I'm just trying to get a one that is closer. Like, which food item do we take that goes together? Once you are eating that food, you must take the other one. I would have loved that anyway.
Bread and
Which food
butter.
item? What do you say?
Bread and butter. Those people are
I can eat bread without butter now.
Bread and
Perfect.
butter is optional now.
I
But
don't even eat
let's see if we can use gari and soup now.
But it's okay. But the bottom line is, we are able to relate to that principle. Okay. Somebody said, Dami said, make a Milo. How? Some people don't even take make self. They just take their Milo and move on. But it's okay.
Shoe and polish. Shoe and
Okay.
polish.
Okay, shoe and polish. Stove and kerosene.
Polish
Okay.
and polish brush.
What do you say?
Polish and polish brush. Polish and that polisher. What are they calling it? You sure cannot use
Okay.
it with the polish.
Polish and the brush. If you cut down the price of polish, more demand for polish, more demand for brush. Okay, at least one thing is very clear.
Toothpaste and brush. Toothbrush.
I've gotten so many people, but I'm happy that the class is, at least the class is not sleeping.
Hello, sir.
Okay. Yes, sir.
I think the complementary product that you just mentioned now must be from the same producer or not.
Yeah, the same producer, yeah.
So all the examples they've been giving do not work.
Hey, no problem. We are not fighting. You give us one now.
Ah.
The one of iPhone and iPhone charger works.
You can now look at, okay, you can now look at Dangote. Dangote produce many items. Now, a good example, look at Dangote. Dangote cement and Dangote bag. Or a closer example. Dangote has a factory that manufactures cement. At the same time, Dangote has a factory that manufactures the bag, that sack bag. When you are done with the production of cement, you require bag to complete the production. Now, if Dangote reduces the price of cement and there's increase in demand for cement, definitely there will be need for more bag. As the company produces more cement, then the company will also need to produce more bag in order to complete the production of cement. I'm just taking that. It might not be perfect example, but like he said, the complementary product must be for the same company. We are trying to reduce the price of one product, that one of our products.
Hello, sir.
Yes, please.
Yeah, there is an example that strikes very perfectly.
Please.
Here in the north. Hello, sir.
Okay. Yes, we are listening.
Here in the north, here you go to buy cow, this animal for meat, either for burial or wedding or anything. You see, beside in that same shop, they sell the rope, and you cannot buy this cow without the rope. If they reduce the prices of their cow, it will make them sell more of the ropes, because you cannot use one rope to tie 2 cows. If you buy 2 cows, you buy 2 ropes. So the prices are related.
Okay. Won't throw it away. I also thought of it because even in Lagos too. Won't throw it away, but look at it. Thank you for look at it, Lily. Let's look at it. If you reduce the price of cow, Will people just go and buy cow like that? That because the price is now cheaper. You know, even the price of rope is too small compared to. Can you increase the price of the rope? Maybe the cow is for like 200,000, 300,000. The rope is just like 1,000 naira now.
We're talking about complementary.
Yes, but won't throw it away because the bottom line is the man that sells cow also sell the rope.
Yeah.
So we won't throw it away entirely.
It's okay.
All right, maybe if I see, I know in those days we used to have this in our secondary school, complementary products. We don't be playing with it. I can't even.
Hello, sir.
It's zinc and nails.
Hello, sir.
Yes, sir.
So we can have a decoder and a dish. You cannot buy a decoder without buying the dish. And most most people that sell decoder also sell the dish separately. So if you must buy the decoder, you must definitely buy the dish in order to be able to view the decoder. That one will work.
Okay. Let me ask: Is the decoder and dish produced and sold by the same company?
No.
Yes, sir. Yes, sir.
Somebody said no.
No.
Well,
Yes.
I won't be able to say dispute your point, but when I bought my decoder, I was given the dish automatically.
They sell it separately sometimes.
I don't know when they started doing that.
Yes, some sell it
And
separately.
maybe now, when I got my decoder, in fact, they gave me the decoder and the dish together.
Hello,
I
sir.
went to multi-choice points. Yes, please.
I think from that example you
I
just
think we
made,
have
we
done
can get
enough.
we can get from that.
Sorry, I can't hear you, please.
I think from the decoder we can still use a sample there. Decoder, dish, and monthly subscription. They can reduce the price of decoder, then
Monthly subscription,
increase.
okay. I think you're right. If you look at it, really, if multi-choice can reduce monthly subscription, most people might demand for decoder. You know, there are two things: buying decoder and monthly subscription. If there is reduction in monthly subscription, most households can subscribe for many people might subscribe for decoder, then subsequently pay their subscription. I don't know. But we have tried. We have tried. Let us round up the class in 30 minutes with question number 4. We have tried. Let's go to question 4. I can do this in 30 minutes. Yes. Look at question number 4. This question can be treated in 30 minutes. The question says, TEDPAC Nigeria Limited, in bracket TNL, produces various types of packaging products for the food industry. TLL has just introduced a new type of pack, and its marketing manager is considering how to penetrate the market with the pack. The following pricing strategy has been suggested. 1, market skimming pricing. 2, market penetration price. 3, full cost plus price. 4, return on investment price. And 5, marginal cost plus price. Continuation. The management accountant has provided the following data about the park. 1, non-current assets needed for the production of the park is 2 million. Working capital requirements are estimated at 400,000. Expected annual sales volume, 40,000 units. Variable production cost are 60 naira per unit. Fixed production cost will be 300,000 each year. And annual non-production cost will be 100,000. The markup for the park will be as follows. If full cost plus price is used, markup is 25%. If marginal cost plus price is used, markup is 40%. A target return on investment of 10% per annum. Requirement A. Discuss the above pricing method and advise when each could be used. Requirement A is for 10 marks. Discuss the above pricing method. Market skimming price, market penetration price, full cost plus price, return on investment price, and marginal cost plus price. And tell us when it is appropriate to use this method. All right. This question was tested 2019 diets. Please, the line is open. Let us discuss. Please discuss with me. What is market skimming pricing method? When it is appropriate to use this method? Yes, the line is open.
Okay, so market skimming method is a pricing technique that aims to introduce a new product into the market at a reduced selling price in order to achieve maximum demand.
At a higher price.
Okay.
So at the higher price.
Please let it speak. And please, if you want to speak and signify by raising up your hand, it's fine. Olakule has made a point, but that point I think is not correct. You need to go back to it. Who is speaking now? Akoli, you want to speak?
Hello, sir.
Yes, who is speaking?
Yusuf.
Okay, Yusuf, please go ahead. After we take Joy.
Market skimming is a pricing strategy whereby a company introduces a new product into the market with a higher price with the view of making as much profit as possible in the early stages of the product life cycle.
Okay. When it is appropriate to use this method?
When a new product is being introduced into the market.
Okay, when a new product is being introduced. All right, thank you. Now let's take Joy. Joy, please speak. Yes, Marcus. Now, please take it from the angle that Yeah, he got the first aspect. Market scheming is a method of charging higher price when introducing a
product
so as to achieve higher profit at the early stage.
Yes,
that is very correct. Now the question is,
okay.
Joy, you can speak.
I said he did not also mention that at that first year they spend heavily on advertisement and sales promotion to obtain.
Okay. To obtain demand, to obtain sales volume. Okay. So what I want somebody to add is, when is it appropriate to use market scheming? Yes.
Yeah, it's appropriate to be used when a new product is being introduced to the market for the first time.
Not only
it is appropriate when you are introducing a differentiated product, particularly a product of
Yeah.
Okay, but you did raise up your hand. But that's very correct. It is more appropriate when you are coming with a product, a new product that is differentiated in the market. Differentiated may be in terms of the quality of the product. People are willing to pay higher price because your product is not only new, but it also comes with a differentiated higher quality. All right, thank you. Yes, Peter was trying to raise up his hand. Higher price. Okay, thank you. Umu. Hold on, JJ's. Yeah, okay, Techno. Now let's move to market penetration. What is market penetration method? And when is it appropriate to use this method? Okay. Oluwase, you want to try? I can see your hand up. Toib. Or is it Akoli? Who is speaking now?
Okay, let me try, sir.
All right.
Market penetration strategy is encouraged when
I think the line went off. I can't hear you.
A very reasonable share of the market.
At the point the line was breaking.
I said market.
Okay, let's take Peter. Peter, will you please speak? Yes, Peter, you can speak. I'm sure you did. Peter, your hand is up, but you are not omitted to speak.
Okay, I can speak now, sir.
Yeah, please go ahead.
Yeah. Market penetration is appropriate when you have a new and differentiated product into the market and you're selling it at a lower price with a view to penetrate the market and win a larger share of the market as quickly as possible in the lifespan of that product.
Okay. I agree with the fact that you are charging a low price with a view to capture and win larger size of the market. But I didn't agree that you have a new and differentiated product. That is why you are charging low price. So I can see Joy also raising up his hand. Are you still there, Joy?
Yes, sir. So I think basically, to my understanding, market penetration is when a company is trying to use the low selling price strategy for new products to penetrate the markets in order to make sales or make sales volume, make a high sales volume. And I think most times they use the cost leadership strategy for market.
That's it. That is what I'm looking for. You can use market penetration by charging a low price as the introduction of the new products, so that you can achieve a larger size. You can take control of higher volume, higher sales demand. This strategy can be used when that company is a cost leader, meaning that you can produce at a reduced, look at it. This pricing strategy can be used when the company is using a cost leadership strategy, where you are able to produce at a reduced cost. Then you can charge lower price. By charging lower selling price, you are going to obtain higher sales volume. That is when we can talk of market penetration. To do market penetration, that company must be a cost leader. Let's move on quickly. So the other three, all right, Umo, you tried. Kasha. So full cost plus pricing method. Full cost plus pricing method.
I think basically full cost pricing plus pricing method is using the absorption technique. That is, you are going to, in arriving at your price, you have to take into consideration your fixed cost and your marginal cost. So everything about the whole absorption.
Your variable cost.
Yes. Everything about the whole
technique
you put into consideration in full cost plus.
Okay, let me sum up that because of time. Kule, please hold on. Full cost plus pricing. Pricing method whereby both the fixed cost and variable cost are included to arrive at the total cost. In addition, a percentage markup is added to the total cost to arrive at the selling price. All right. Next, marginal cost plus price. Okay, before we go, when is it appropriate to use full cost plus pricing? When is it appropriate for company to use full cost plus pricing? When you are looking at, you can use full cost plus pricing if for planning purposes. If you are setting a selling price for planning purposes, you can use full cost. If you are looking at appraisal of divisional performance, look at it here, please. It is useful when operating on historical basis for planning purposes, appraisal of divisional performance. We can use full cost plus method. All right. Olakule, marginal cost plus pricing method. if you are willing to.
Okay, so marginal cost plus pricing method is considering only the variable cost of production and adding a markup to arrive at the selling price of that product.
Okay, good. Only the relevant cost of production. Relevant cost include all the variable cost and relevant fixed cost. Relevant fixed cost is the incremental fixed cost. Then when you have gotten your marginal cost, you now add a percentage markup to arrive at the selling price. This method is used when preparing your marginal cost statement. Let's move it quickly. Lastly, return on investment costing method. Like we explained, under this method, the return on investment is calculated. Target return on investment is calculated and added to the total cost of the business so as to arrive at the selling price. This method can be used for divisional appraisal, performance appraiser. Okay. The explanation will fetch you 10 marks. The B part of this question. Calculate what the price of the pack should be if its price is based on 1, full cost plus pricing, 2, marginal cost plus pricing, 3, return on investment pricing. The B part is for 5 marks. So what is the price going to be? What will be the selling price if it is based on full cost plus? That means I will come here for full cost. I will take the variable cost. I will take the fixed cost, all the cost. Is that not? Variable cost per unit, 60 naira. I have the fixed production cost and annual non-production cost given in total. So what will be the selling price? Let's go to this solution. Tonight we might not use, okay, we might not use board. It just is, we can deal with it on the page here. Look at it. Full cost. Pick your variable cost. All the variable cost per unit. Then the fixed cost. Look at the fixed cost. Our fixed cost, we have fixed production cost, 300,000. Then we have non-production cost, 100,000. The total is 400,000. The total fixed cost include production fixed cost and non-production fixed cost. The production fixed cost is 300,000. The non-production cost is 100,000. Please sum this together. That will give you 400,000. Now, we now want to get the cost per unit. Our variable cost is per unit. And I want to get the total fixed cost per unit. Go back to the question. What is the unit produced in the question? Look at it. Expected annual sales volume is 40,000.
10 naira.
Sorry, any question, please? The annual volume is 40,000 units. So what is total fees cost per unit?
10 naira, sir.
Yes, please go ahead.
10 naira.
10 naira, thank you.
And
That's the working here. We can deal with it without the whiteboard here. 400,000 divided by 40,000 units. That gives us 10 naira. That means total cost is 70 naira. That is the full cost per unit is 70 naira. The total full cost per unit, 70 naira. Now add a markup to the cost. I will now come here. What is the markup if you are using full cost? Look at the question, please. If full cost plus price is used, the markup is 25%. Now come here. Look at it, please. Please compute 25% of 70 naira. What do you have?
17 naira 50 kobo.
Thank you. This will be added to the total cost per unit. The selling price becomes how much, please?
87 naira 50 kobo.
Thank you. That means if we are using full cost plus pricing, the selling price per pack is 87 naira 50 kobo. Any question, please? All right. Now the second one say marginal cost plus. For marginal cost, only the variable cost we are going to pick. Because we are not told that this fees cost is incremental. Pick your variable cost only. What is the markup?
24 naira.
Let's go and check. Don't worry. Let's go to it because look at it. If marginal cost plus price is used, the markup is 40%. Please compute 40% of 60 naira. What do you have?
24 naira.
So this is the markup. Add back to the cost.
84 naira.
Selling price is what?
84 naira.
So if the company 84 naira per pack, if the company decides to use marginal cost plus method, the selling price will be 84 naira per unit. Is that point clear, please?
Yes, sir.
Right, the third one. Return on investment pricing. For this method, first, determine the total investment. Determine the total capital employed or total investment. Let's go to the question. Look at the investments. Non-current asset needed for the production of the pack, 2 million. That means we must invest 2 million to purchase non-current assets. Working capital requirements are estimated at 400,000. That means we must invest 400,000 for working capital. Total investment is 2 million plus 400. That gives us 2.4 million. Is that clear, please? Next. What is the target return on investment?
10%.
10%. So please compute 10% of 2.4 million.
240.
Look at the total investment, 2.4 million. Required return or profits, 10%. This is 240. This 240,000 return is the return for number of units sold. That is the total return on investment. What is the return per unit? Look at it. Profit per unit. We are going to produce 40,000 units. Total return is 240. What is the profit per unit? 240,000 divided by 40,000. That gives us 6 naira. That is the
1,000 is for where?
Sorry, sir. What do you say?
I mean the 40,000 that will divide them.
Okay. That is the volume of sales.
Okay.
Look at it, please. You know the 240,000 is the whole return you are going to get if you produce and sold 40,000 units. The 240,000 naira, 240,000 is the return you are going to get for producing and selling 40,000 units. That's okay. What is the profit per unit? Total profit is 240,000. What is the profit per unit? 240,000 divided by number of units sold. 40,000 units. That gives us 6 naira. I will now come here. Selling price is equal to, based on return on investment, variable cost plus fixed cost, total cost 70. Then target return per unit, 6 naira. The target return per unit is 6 naira. Therefore, selling price per unit is equal to 70 plus 6 naira. That will give us 76 naira per unit. That is the return on investment pricing method. Right? The time is well spent. The class has been very, very participatory. That's good. Any question, please?
If we are asked to choose among the prices, which of the method will fit into the prices? As in we have 76 for 76.
Okay.
Yes, sir. Yes.
I can hear you. I can hear you. Go ahead.
Yes. If we are asked among the prices,
to recommend which price is better.
Which price is better?
Okay. To me, you are asked to add that, okay, make recommendation. No one is like the best. It depends on what the company wants to achieve. This full cost pricing has advantages and disadvantages. For example, this method is good because it covers all the costs of the business. But it is not good for decision making. full cost pricing is not good for decision making. Marginal cost price is good for decision making. But we cannot use marginal cost by income statements. So if you are to make recommendation, you are not for this particular question, you cannot be specific. But there are some questions that examiner will give you different prices. Well, whichever one give you the highest profits. Okay, that's the best method is that method that maximizes profits. Thank you, Techno. Any other question, please? All right. It's a good evening. May God give us a better understanding.
Amen.
Please, gradually we are moving. Our next class, we shall look at calculation of theoretical approach to pricing. Looking forward to seeing us again on Wednesday. May God, let's have a blessed evening. I will be checking out of this classroom. Thank you.
Thank you, sir. And good night, sir.
And good night.
Good night, sir.
Good night.
Yes, sir. Thank you very much.